But good little start to this weekend. I've been writing a lot. There's a lot of commentary coming. We got a lot to cover today because, I wanted to give everybody kind of a bit of a breakdown and understanding what's actually happening in this market from a technical perspective and just walk you through a lot of these things that become quite complex, right? They seem much more difficult than they are because they use large terminology. And as we look at this, we're at 6,000. And for a lot of people, they might be saying to themselves, how did we get here, right? How did we get back here from 48.50 just about 2 months ago to the day? It's June 9th, right? So the turnaround really started on April 9th. And what happened? Well, once again, we go back to that chart. We just show you, specifically just looking at the SPY, that at this period back here, this bottom, massive levels of insider buying, and a pivot on policy. Those are the only two things I'm really looking for in these emergency situations, where you get to a point where there is massive levels of insider buying to selling. This is very simple. It sounds overly simplistic, and as I have continued to note, when it comes to the markets themselves, the simpler is the better in a world that has been heavily driven by algorithms, zero date, high frequency trading. This is the level that we look at. This is insider buying net to selling. This is dollar for dollar, and all it is a 5-day ratio. This 5-day ratio tells you if executives are putting their own money down. They are always selling. Keep this in mind. They are always selling. Many are compensated in stock. We are looking for a large spike in this 5-day period. And there it was, April 9th. The next thing we look for to help justify this is a policy change. And there was a big policy change on April 9th, April 10th. And that was effectively abandoning Liberation Day. The bond market did not like it. The bond market broke every plan that there was. And now we are back to the status quo because there has been a lot more liquidity added to the system and the markets have rebounded. That is where we're going to talk about. We're going to talk about how this type of event has now put us in the situation we are in. We are in a very vulnerable spot, but we are also in a position where this market could actually continue to run to levels that most people thought it would before we even had this crisis. Remember, average price projection for the S&P 500 this year was 6,600. I laid out 5 cases to start the year. My high of the year was 7,100. My base case was about 66. My trade crash was 4,800. We have a panic and then we sell off and then we have a negotiation was 5,500. We've hit all of these targets except for the ones to the upside, and I'm going to show you why the upside is still potentially there. We're also going to talk about regional banks. I got a question in email. I get a lot of questions. I appreciate them very much. But the question was around regional banking stocks. Regional banking stocks, 20-day EMA, the DPST, which is the leveraged ETF around regional banks, has pushed above its 50 and its 20-day EMA. The question becomes, is this a fast trade to make? And I'm going to lay out both cases today of yes and no. Core things before we start. Last week, the Trump chaos driving headlines. We scalped gains Thursday. FinViz and TradingView suggest continuation in Tesla and a move continued lower. This morning, 290 on Tesla. And why does that matter? Well, because as I noted last week when I was talking about on Thursday morning, I said, Tesla looks like it's time to short this stock. It had nothing to do with Trump. It had nothing to do with Musk. It had to do with the fact that we were in this liquidity gap. We started to have this move on the 20-day moving average to the downside, and it seemed like a good opportunity to trade the 30, buying the 330 call, put, selling the 310. Well, we found ourselves right in the middle of the news cycle, and the stock broke down further in a day than I certainly expected. I'm not going to turn it down. I'm not going to sit here and claim that I wasn't happy with it. But as I did note, in this environment, the stock itself pushed under those two averages and then led to a little bit of a pop on Friday. I still think the continuation here is to the downside. But for me, a person who is focusing specifically around these two moving averages and so much visibility in this trade, I've walked away. There's other things that I can do. I made my gain on Thursday. A lot of other people were telling me in the chat they made 67%, 70%. What do you do now? Go enjoy the gain. You don't have to try to just do things every single day. Look for continuation down, 2-3 more days of this. Obviously, looking for more downside. I would keep a very close eye on the MFI. And if the MFI starts to drop as a continuation of the RSI, that becomes a place to continue trading it to the downside. In addition, pay very close attention when we get into oversold territory on the RSI. Yes, Tesla can remain lower for longer, but at this point, what we're looking for is a period where you have oversold on RSI, oversold on MFI for a short-term squeeze. That is where I would anticipate that we would see the individuals who are shorting this stock try to take us a little bit higher. Okay, can you imagine buying NVIDIA at 30 after it has 10 times? Okay. All right. The key levels matter more than the narrative. So with Tesla, I would like to see it retest its 50 before I try to go after it again. Apple got a downgrade from Needham. And Needham said, don't touch this stock until it hits 160, 170. Well, some people are active long-term investors in Apple. And some people trade Apple because it is a great stock to trade. As I'm going to explain momentarily, there still is a lot of opportunity in this market, but it is purely momentum driven. It is not driven by fundamentals. So you have Needham, you have all these CFAs, you have all these guys in there who are sitting here going through the balance sheet and reading the 10K. And I'm telling you, it doesn't matter. Because in a heavily liquidity driven market where credit is what is driving this market more than the underlying fundamentals, if we break under this 20-day moving average, a lot of people are going to say, I want to try to short Apple. Don't start playing into the options game. Pay very close attention to this because remember, the purpose of the market is to sell, and a lot of these dealers would love to sell you 190, 180, 170 call put options, but keep in mind, as I'll explain momentarily, there still could potentially be a significant amount of upside to Apple stock simply because of the underpinnings of the market. So when we get into Apple and we get under that 20-day moving average, look at the AAPD. This is an inverse ETF of Apple stock. And as you can see at 1-to-1, there's no decay in this. And when we have breakdowns in this stock, we have breakdowns in this stock. It tends to break down under both of those moving averages. So again, this is the inverse, trading it from here, 16 to 1750. You can do quite a bit with that. Obviously, you've seen these other significant moves, but these inverse ETFs become their own form of momentum trades. So same rules apply. Strong RSI, strong MFI, strong MACD, strong ADX. That's what you're looking for. And right now, the ADX is telling us probably not the time to try to short Apple. Wait until we get up here and then make that move. Needham is making that recommendation, but once again, the underlying fundamentals have not really mattered all that much. This company has not innovated anything in a couple of years. This is still a very heavily treasury-driven market. I wrote about this extensively over the weekend. I'm going to write about it a lot this week. Short-term flooding of the T-bills, that gooses economic activity. That increases credit and leverage and risk in the system. Bessent is doing exactly what Yellen did. They are going to be focusing on the short-term end of the curve. Now, here's the very important part of this. I want to just note this. We've had a lot of people ask questions like, how long can they do this? How long can they just start selling short-term U.S. debt and let it go? The answer is until it breaks, but I would anticipate it's probably going to be if and when the one-year Treasury bond got somewhere in the 5.5% to 6% level. Now, that is a significant problem, right? In that environment, short-term debt costing that much. But right now, I'm just not seeing it. And right now, the other thing to keep in mind is that the Treasury Department and the Fed can and will engage in some level of QE or non-QE or yield control or non-yield control, however they want to define it. The end goal is to drive capital into the U.S. coffers. So this is a liquidity-driven rally. There's a lot of hedge fund leverage. It's not fundamentally driven. It's just not. You're going to hear people still talking about this stuff because, trust me, I have the education. I would love to sit around and tell you all of the wonderful things that I learned reading things in Kaya and reading the CFA books and what my MBA finance professors told me. And I'm telling you right now, the greatest correlation is between liquidity in the system and the performance of the MSCI index, which is the global index, and that just hit a record high, as liquidity just hit a record high. So I'm going to reject all of the hundreds of thousands of dollars that I spent on all of that education and simplify it and dumb it down, because this has been the market since post 2020. With that said, zero date more important than ever. I highly encourage you to check out what Don was talking about earlier last week. Great presentation on zero date options. Buying the dip has become a coded reflex in these markets, and new strategies are required. I've walked you through how to trade zero date with volume weighted average price. But Don has a little bit of a different strategy that reduces risk, because once again, as I've said, just because the S&P 500 falls into that fourth deviation does not mean it's going to rebound with significant certainty. And you have to be fast, and you have to be quick, and you have to be able to trade options very quickly using my strategy. Don's got a little something that's a little bit easier to operate. The last thing at the headline level, very important, gold at the central banking level. The May numbers came in. They were not as strong as April, but they were still pretty damn strong. And places like Kazakhstan and Russia and Poland and China, they're still buying up gold. And as I've noted, if the countries that are making fiat currency, if those entities, those central banks are the ones that are buying up rocks, maybe we should buy some rocks too. Because again, the ongoing trend remains currency debasement into the future. The U.S. dollar continues to lose roughly 6 to 8% when you include all of the shadow banking elements. That is not showing up at CPI. So again, silver surging, gold surging. I did warn last week that silver kind of is like a drunk wedding guest. Sometimes it actually can go in a straight line and stumble forward and continue to move along with gold, and sometimes it just doesn't. So, as I've said, if you missed this silver surge that just transpired on that 20-day moving average, just wait. It's going to come back. There's going to be some convergence between the price and the 20-day at some point and the 50-day at some point. So you don't have to just try to buy, unless you're a long-term silver holder. I am. I've been buying silver since 2008, and I have done well, obviously, but at the same time, that was money that I didn't allocate to the S&P 500, which has done far better. Far better. What Canadian gold company do you buy? That is the PHYS, and that is not a gold manufacturer. This is a trust. This is the Sprott Physical Gold Trust. And what I really like about this, aside from the fact that this is Sprott Management out in Carlsbad, California, and up in Toronto, they legitimately just buy a pile of gold. They own a ton of gold bricks. This is a closed-end fund, and you own shares that are connected to the underlying gold itself. What I like about this is that if you wanted to, if you have $1 million and you wanted to take delivery of gold, you can. So we know that this is audited. We know that this is effectively a way to own gold without having to rely on futures contracts and all of the paper. This is simply tied to the underlying asset. And again, you could take delivery if you have enough money to do it. I think Michael Burry did this a couple of years ago and bought this at a discounted roughly 5 or 6% because of the nature of a closed-end fund, but then actually did take delivery of the gold. Momentum right now remains positive. This is in the intraday side. It's very strong momentum on the weekly level. We're back in breakout mode, and I'll explain why momentarily. The strong stocks that we're watching, PAGP, which is one of my favorite midstream companies. I continue to say there's always money in the midstream. If you are a trader in the natural gas space and you're looking for something, this is a nice little move, a little bit of a breakout above that 50-day now. These things have room to run. But again, this is a pipeline company, right? Pipeline companies are not supposed to be this volatile. You're not supposed to have big moves on this. I mean, ET is a good example of this as well, where, range bound 16 to 20. I continue to advocate you buy this stuff down here, you sell it up here if you can, or you sell spreads when we get up into these ranges. But down here at that $17 level, one of the gifts that keeps on giving in this market. IQV is back in focus again as well. It could be a very interesting stock, really beaten up, but this is one of those names in the AI space that continues to pop up on my radar, push above that 20-day moving average. I do like this company for the long term, but that said, it is a heavily liquidity-driven stock. It is a momentum stock, and if you're trading it, it becomes right back here at your 50-day moving average, 152. There have been some pretty good breakouts on this. We've seen 10, 15% moves. Once again, coming off of 138. So here, 152 effectively becomes the stop for a swing trade on the underlying stock. And SanDisk, SNDK, again, back in this environment. This was a recent IPO, got beaten up a little bit on that move on that EMA, but now trying to pop above that 50-day. We finally had the time period that we could actually get a 50-day moving average. That is back in focus. Stocks breaking down, not a lot of them. Tesla, obviously, back in focus. I think that it does have downside, but I am out of that trade. I will wait a couple of weeks, couple of months for the opportunity to reemerge again into the rotation. If I'm trading Tesla today, I'll probably just use volume weighted average price, TSLL or TSLQ. I'm also looking very closely on the TSLQ right now, which is the double short ETF for Tesla. If this breaks above its 50-day moving average, that is where I will buy it. But for right now, I'm going to be a little cautious of this range on the TSLQ. When this breaks both, that's typically where it becomes a short-term, multi-week trade. You could see this went from 35 to 70 at the height of that crisis. But this was back here. This was the Nikkei crisis, broke the 20 and the 50, 183 up to 243. Obviously, this is decay-oriented, but we've seen 20 to 25% moves above that 50-day moving average. Add that to your radar. Oatly back in focus. Just watching that little tiny Swedish oat milk company up another 1% this morning. Breakout move here off that 20-day moving average. In addition to that, Riot just looks like one of those names that can just pure momentum to the upside. I would not be shocked to see this back near multi-month highs within the next couple of weeks. So if you're trading Riot, buy the stock, set a stop back around $9. This is again another heavily liquidity driven stock. And what's very important about this is the beta. Tech beta, very high beta stocks are on the move, as I'm going to explain right now. All right, just looking in the chat right now. As I said, PHYS is the ticker that I'm watching. Don's putting in the chat that I will be back here at 12:30. So thank you very much. Now I know that, as well as looking at what Paul's got to say. I don't know what you're saying, Paul. What are you saying? Cool. All right. So state of the market, state as we head into this week. This is very important because this is not a environment that is safe, but here we are. We're back at 6,000. And as I've said, this market is very, very similar to 2022, where all of a sudden, all the sentiment has completely flipped to a different direction. And everyone's saying, wait a minute, what happened, right? The S&P 500 is near all-time highs, right? But the headlines lie. We're not there yet, but we're almost there. Looking at the SPY, I think 6,100 is kind of where we'd be looking at. Yes, so we're within range. Forgive the typo here. This is a rally that is not built on earnings growth or fundamentals. This is completely driven by algorithmic flows, leverage loops, and panic buys. Now, what does all of that mean? What's lifting the market now could easily crush it within the next 2 weeks, and we are heading into Third Friday. But this is the systematic positioning of equities in the U.S. market right now. Now, you're probably looking at this saying, I have no idea what this even means, right? Okay, so what you're seeing in this chart is a Goldman Sachs chart that is effectively laying out the systemic U.S. equity exposure is near cycle lows. So these are CTAs, risk parity funds, quant-driven models. Oh, you might not know what I'm talking about. Isn't finance fun? Isn't it great that it's just completely and totally driven by this stuff? Okay. These things buy and they sell on trends and volatility. They don't focus on narrative, and they don't focus on valuation. And that's the problem. If this rally keeps grinding higher, they have to buy. They become forced buyers. So their models will trigger more exposure, and this drives even more demand in equities. It is a feedback loop. So the higher that we go, the more they have to buy, regardless of the macro conditions. They could come out tomorrow and say the jobs report was minus 500,000. But if the momentum still remains in the market because there's a complete disconnect between the S&P 500 and the underlying economy anyway, this market is not being led by confidence. That's what this chart is showing us. It is showing us that it is bullish until it isn't, because it's being dragged upward by blind algorithms that are chasing momentum. Again, isn't momentum and finance fun? Quant funds remain underexposed. Models are based on price trends. Higher the stocks go, the more they have to chase. And it is a feedback loop. Momentum brings more buying until it breaks. Which brings us to our next chart. Hey, all right, what in the hell is this? Well, this is hedge fund leverage. This is really fascinating because right now, remember, just a couple of weeks ago, we were utterly in the toilet. Gross leverage has just hit the 99th percentile. Hedge funds are nearly all in right now. But net leverage, which is longs minus short, is still pretty moderate. And that means that funds have to make a decision. They are juggling so many positions that they will have to rebalance if volatility picks up. And right now, volatility is at 18.5. We get to 22, we get to 23, we get to 25. This chart becomes more important than you would ever imagine. Hedge funds are basically standing on a seesaw right now with cinder blocks in each hand. And if prices keep going higher, they have to cover the shorts by buying more longs to keep their positioning balanced. And that extends that upside. But if anything freaks this market out, CPI comes out later this week, right? Geopolitical shock. We have these conversations going on between China and the United States. If we have a bond market tantrum, and we have had plenty of those, they will have to de-risk, and they have to do it very quickly. And imagine this, because the window is very short. It is like trying to move an ocean through a bathroom window. So we have an over-leveraged and an under-cushioned market, and sentiment could go from bad to brutal in 48 hours. This is a very difficult environment, so you have to be very, very cautious. And that brings us to our third thing driving this market, FOMO, especially on tech. This is a state of denial. And this is where it gets wild, because the biggest tech long buying binge has happened in a decade. There's your prime book. That just happened at the end of May. After fleeing tech, after that huge move down, and remember, here is the FNGD, right? We broke above the FNGD. This became a confirmation on momentum. Now turn the other way and look at the FNGB. Look how far away this thing is now from its 50-day moving average, 37%. Look at the MAGs. The MAGs is now currently 10% above its 50-day moving average. We have been extended on high beta tech in a very pronounced way. We are currently 30% on the S&P 500 leveraged high beta ETF from its 50-day. This is not rotation. This is desperation. This is what FOMO looks like. The sector was dumped months ago. It is now long positions are outpacing short sales by 1.6 to 1. That's what that red line is. So this is manic buying in Nvidia and SMCI and high momentum names. The crowd that dumped tech in a month ago, 2 months ago, is now piling back in. So you have three major trends all pushing this market back to near record highs. And I haven't even talked about momentum and the liquidity expansion. I'm just focusing on the underlying things, the forced mechanical buying, the dangerous leverage levels of leverage, and the sudden momentum chasing. There's no earnings story. There's no productivity revolution. This is just flow-based levitation and algos hurting liquidity uphill. Can it go higher? 100%. The structure actually supports further upside until volatility spikes or yield spike. But then that unwind starts, and it will not be gradual. It will be fast. It will be unforgiving. And if you're long, ride the wave, but hedge your downside. If you're short, tread carefully. The mechanics are against you. And if you're in cash, do not chase until you understand the risks that are behind this curtain. This is a momentum market. This is a liquidity market. This is not a bull market. There is no such thing as a bull market anymore. There is momentum and liquidity. That's it. A bull market is what your grandfather said back when actually markets were driven by fundamentals, when the economy and the markets were actually aligned. They're not. They're not. So this 6,000 level is very important. You want to pay very close attention to the overbought levels. And you also want to pay very close attention to those indicators that I've talked about, specifically the 20-day moving average on the FNGD. The last time that we got into this type of environment, obviously we've seen before back here in April, but I'm talking about events like what just transpired last year with the Nikkei, right? We started to sell off. We had a little bit of a squeeze, and then we absolutely cratered. Very fast and furious move. We had this type of thing happen back here with the gilt crisis. We had this type of move back here with the Silicon Valley banking crisis. Don't flinch on this. We have had four Sigma events transpire in the last 4 years, and we don't talk about it. We're going to probably have another one within the next 8 months, and all of the technicals will be your first move out of this market and start protecting yourself. Right now, the music is playing. We're all dancing. We're having a great time. But my job, in a lot of ways, is to always keep people understanding that these things move fast and there is a pattern to it. There is a momentum sell-off. There is a complete lack of buying. There is a short squeeze, and then there is a dump. And then there is massive levels of insider buying to accommodate policy changes, and then we do the whole dance over again. This is not stable. So again, rally can go higher until volatility or rates derail it. If you're long, hedge. If you're short, stay cautious. If you're cash, be patient. Don't chase surface level strength. Okay? Good. Why did you say the shorts should be cautious when all three of your background slides are very bearish? Well, again, they're not. They're actually not bearish. This is you as you can see, these things can squeeze much higher. So shorts have to be cautious because none of the momentum at the moment suggests that it is time to bet against it. As I've noted, the optimal time to be the short, to be the bear, is when we start to break these technicals. We're nowhere near that yet. So if you want to be first over the wall, go ahead. But understand this market can grind higher. I'm going to be moving in when our equation goes negative and we start to break these levels on the FNGD. And I'm going to wait. Central banks are providing support. Treasuries providing support. Ample levels of liquidity in the system. It ain't over yet. It's coming, but it ain't over yet. And I am not going to be the first person to try to short this market. I will be the second or the third and be happy about it. Speaking of which, somebody sent me a note. I talked a little bit about regional banks. This is a very good question because, as you know, I focus heavily around that 20-day moving average. And DPST is the leveraged ETF for the regional banks. So here you go. Move above that 50, move about the 20. And the question was, hey, Is this the time to go long regional banks? Don's going to be first. Good. You be first. I will be second or third or possibly fourth. I am going to wait for the optimal moves on the technicals. All right. Once again, here's the DPST. We push above the 20-day moving average. The question was, all right, RSI is improving, relative strength. That is the price index. Perfect. Coming off of oversold on the MFI. Is this the optimal time to go long regional banks? All right. So the DPST is at that level, and the breakout suggests buyers are gaining control and the technical confirmation of a short-term uptrend. Momentum indicators, again, 54 to 55, bullish neutral zone. The MACD is a positive crossover, which we discussed right here. Looking for this cross right here. And in addition to that, the ADX is at 15, an early sign of confirmation, 14.9. So we're early, right? This is very early. This is maybe at dawn, early, right? RSI has been rising, but the MFI, remember, that is price and volume momentum, which means the capital flow is currently lagging behind price momentum. There's not volume here confirming this move yet, right? There's just not volume here yet. So we're going to watch for the MFI to stay above 54, the core move here. Now, net interest margin expansion from higher rates is one of the big macro drivers in the banks. They had stabilization in their deposit trends. They had stabilization in their earnings. The Fed pause and easing signals have reduced pressure on regional banks, in addition to the fact that we've heard Bessent talk about regulatory changes. This also was oversold, and that can help fuel a rally. So the question now becomes, how do you trade this? Well, I would like to see the MFI back above 50 before confirming and following a momentum trade. But an early trader, right? An early trader will try to be aggressive, try to buy on the breakout with a tight stop. So if I'm going to be aggressive about this, I'm going to go back and I'll look at the KRE. I might look at some of the specific regional banks. This effectively becomes my stop. Probably my 50-day becomes my stop, which isn't that bad. It's $2. And once again, there could be a very solid breakout here, but you want to monitor volume and front-end liquidity flows. So once again, I would prefer, particularly around banks, because I'm not a banking expert, and I recognize that banks move differently than and are so driven by central banking policy that I'm going to probably focus a little bit differently in some other sectors. But I do like the fact that there is ample liquidity in the market. I do like the fact that the Treasury Department is doing what it's doing to help support the banking system. So there does seem to be some early momentum here. But I would, because of the lack of the volume flow here evident from the MFI, I'm probably going to keep an extraordinarily tight stop here. If we get the MFI back above 50 and the RSI continues to hum, that's where I'm going to have a little bit more confidence. All right. So it is 9:20. Once again, as I noted, very heavy zero date environment. And that is not going away. So do me a favor, click on the link if we throw that in for Don's zero date Don from last week. In addition, I want you to keep a very close eye on the SPX. In this environment, these types of moves, as we saw last week, 2 taps on that fourth deviation line on the SPX. That leads to opportunities to trade the short-term in-the-money call. We'll be looking for that exact same type of setup again today. And in this environment where there is ample upside, but also ample downside because of the things that I just laid out, zero date's going to matter more than ever. So we'll talk a little bit more about zero date tomorrow. We'll dig into volume weighted average price. We'll see how price action is on this Monday, and we will go from here. I hope you guys have a great day. I hope you got a lot out of this. And if you have other questions, throw them in the chat, or obviously go to support@TheoTrade.com. Just have them forwarded to me, and I will answer any questions you have. I hope everybody has a great day. Don's coming up momentarily. Talk to you soon. Have a great day.